This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Robert's picture saying, looking for the downloads. Okay, Eric, let's start off with the equity markets. What are you seeing here?
Until this week, I think the market has been caught up in a Goldilocks consensus view that Trump 2.0 can only be good for the stock market because regardless of whether you personally agree with Trump's politics, his policies seemingly have to be favorable for financial risk assets. I think the situation is more nuanced and complex than that one scenario viewed in isolation. Now, first of all, yes, the Trump gets his way scenario could bring about a major economic transformation if the Trump administration is successful in its goal of draining the swamp, making government more efficient, and reforming federal bureaucracies to make them serve the people better. And yes, that could even evolve into a global trend where other countries demand reform of their governments as well. But I think too many people have been wishing for those outcomes without thinking about other possibilities. It would be horribly naive to assume that that's the only possible outcome. Look, Donald Trump isn't just disliked in Washington. He quite literally poses an existential threat to establishment Washington, which won't go down without a fight. As Chuck Schumer famously told Rachel Maddow, you don't mess with the intelligence community because they have 6 ways from Sunday to get even with you, and everyone in Washington knows that. Trump isn't just bucking the system a little bit. He's taking the so-called deep state head on, and he seems to be saying that Washington is a town that isn't big enough for both Donald Trump and the establishment wings of both parties and their entrenched bureaucrats and intelligence agencies. So the big open question is whether the Trump 2.0 administration can achieve their goals or if the entrenched powers that be figure out a way to eliminate Trump and his movement completely. Now, I don't rule out further assassination attempts, but I don't see those as the base case either. It would cause too much blowback and too much unrest if that were to occur. So I don't think that deep state Washington is going to kill President Trump. They'll be much more crafty about how they take him out. Now, of course, he could still be killed by some nutcase, but I think that if the deep state takes him out, they'll be much more precise and much more stealthy about how they do it. As Schumer said, the intelligence community has at least 6 ways from Sunday to deal with people who threaten them, and many of those ways are much more subtle than assassinations. So if a scandal erupts early in the Trump 2.0 administration where Trump has supposedly committed horrible, impeachable offenses, frankly, I'll be more inclined to question whether he was framed than whether he's actually culpable. But I won't be the slightest bit surprised when that sort of news breaks. Bottom line, Trump gets his way could be incredibly bullish for the stock market, but Trump gets hit with all 6 ways from Sunday all at once could be an outright market crash scenario, which if they do it right, they'll make Trump himself the scapegoat for causing the market event. So I see 2025 as a gigantic year of tail risks, both left and right. I think the market first started sniffing out the left tail with Wednesday's sell-off to the 50-day moving average on the S&P. Let's see what comes next. It's still possible that the right tail dominates and that Trump starts a revolution, which really could be remarkable and amazing and propel the stock market to new heights. But I think it's equally likely, if not more likely, that they figure out a way to take him out and they could take markets down in the process.
Eric, on page 2, I have that S&P 500 futures chart with that 50-day moving average on there. We were in a period of complacency on the S&P 500, stuck in gamma pinning, and at the same time, those Mag 7s were the ones ripping exponentially to the upside, reaching some distinct exhaustion points. So we had a very overbought Mag 7 market and an underpinning market that was already selling. To really illustrate the severity of this is on page 3, I have the breadth chart of the percentage of stocks above their 50-day moving averages. We're only one day off of the S&P highs, and yet the breadth of the market went from several weeks ago being at 70% of stocks above their 50-day to now just 20%. And most of that drop just literally happened in one day. It just shows how many stocks were already downtrending and how quickly this now became an active distribution. The big question is that will the bulls show up in this holiday lower volume period? As far as I'm concerned, we're getting into the Christmas season next week and into the New Year's where a lot of people take time off. Will there be active buying to support and buy this dip? Now, getting a reaction at some point from such a big down day is very typical and normal, but the bigger question, are the highs in? Will the market do a double top retest, kind of fade this early thing? My view here is that the market was long overdue for one of these corrections, and we haven't had a decent market correction that sees any sustained period below the 50-day for a while. And so for this to potentially use this low volume period to get a little spicy going into this window of time, I think the downside window can increasingly open, especially now that people are realizing that the Fed is not going to be continuing to feed this market. And so I think that Powell sent a very clear message. This could spur a bigger sell-off that's long overdue. All right, Eric, let's talk about the dollar.
The Dixie had been in a consolidation pattern just below 107, but I think Wednesday's blowout to test 108 was an important tell that we could be headed much higher, maybe even above the prior high, or at least the high for recent years, that is, of 116 on the Dixie. Now, obviously, Wednesday's spike higher was a knee-jerk reaction to unexpectedly hawkish comments from the Fed, as it's becoming clearer and clearer that inflation isn't going away anytime soon. But we have to ask the question, okay, the Fed just completely changed their tune, and I don't think it was just data that caused it. Is the Fed going to continue to have a changed tune, and how changed is it going to get? So it's still possible that this could all retrace back to the downside. It was just a knee-jerk reaction, and that was it. But if we continue to see the Dixie move higher, above 108, and that's now become my base case scenario, it would mean both a stronger dollar and a lot of trouble for risk assets could lay ahead. It will be important to watch what the incoming Trump administration has to say about its dollar policy and its intentions associated therewith. So I don't think we have conclusive data quite yet, but my spidey senses tell me that the dollar higher, stocks lower scenario could very well be in the cards.
Yeah, Eric, on page 4, I have that U.S. dollar index, and we can see that distinct breakout to year highs. And we're now in a situation where the deterioration of the euro, the Canadian dollar, and so many of these other currencies is just getting underway. If we have any significant U.S. dollar rally that goes further, which I think is in the cards here, going right back to even 112, 113, that will actually feed the risk-off impulse in the broader risk assets. And this is, I think, one of the key macro charts to watch. It's going to continue to feed the anxiety associated with a lot of the other risk assets. Eric, I want to move on to crude oil on page 5. And we have, over the last 3-4 months, been establishing a very distinct base of fair value zone on crude oil. And while the support line has held oil very well, and certainly no major reactions on Wednesday's market move, it is still stuck deep in the trade range, with 50-day moving average being sort of the upper boundary of this area. I think that in order for the bulls in any way to begin some sort of squeezing to the upside, we have to see sustained price action north of $70. And so far, that has actually been a ceiling feeling where a little bit of distribution continues to come in. I'm going into the holiday period quite neutral crude oil, but at some point, a short squeeze that gets this up into the mid to high 70s, it would be just the type of a surprise for a lot of oil bears are not ready for. A squeeze that is just going to be liquidity driven. I don't think you even need a fundamental reason for that kind of a squeeze to occur. All right, let's move on and talk gold. What are you thinking here?
Well, there's still just barely room for gold to bottom right here and reverse higher if it turns out that the dollar rally is all just a false alarm. But I think the more likely outcome is a continued sell-off to test long-term support, which is probably the 200-day moving average, currently down around 2480, but it'll probably be up to 2500 by the time we get to actually test it. I've considerably de-risked my own gold longs and will start scaling back in just above 2,500. Now, again, there's definitely a case to be made that we're already testing the bottom here, and it will, instantly start to retrace higher tomorrow. But if that's going to happen, it has to happen very quickly, and for now, I'm not betting on it happening. I think a deeper correction is more likely unless there's a policy announcement that reverses Wednesday's reaction to the Fed's sudden hawkishness, or if there's some other news which causes, if Jay Powell clarifies and said he didn't really mean to be so hawkish, something like that signals the Fed is not making a pivot of policy, which is the way it feels to me. If they signal that, it could change everything. We could see that gold is done here and it's upside from here. But absent that, I think there's probably more gold weakness to come.
On page 6, I have that gold chart, and we did last week see an attempted breakout as it broke above those November highs on a closing basis, asking the question whether it was starting a new bull breakout on the upside. That quickly faded. What we know is that back in October, we put in the high of the year. At this stage, the likelihood in the next 2 weeks of us getting up there is very unlikely. And so we have been in a 2-month consolidation, and the consolidations often can do as much as like a 50% retrace. So us heading to that 2,500 number that you suggested is a support area that can easily be tested during a consolidation phase. I remain big picture bullish gold, but we are in the consolidation phase. The consolidation phase can last for the rest of this year and even into early January, especially if there's broader risk off going on in almost all other assets. This will lead to, though, a key buying opportunity. We'll keep everyone updated as to when those turn points are developing. All right, Eric, let's talk uranium. What's on your mind here?
The fundamentals for the nuclear energy sector generally, and that includes uranium and uranium miners, couldn't possibly be more bullish intermediate to long term. The nuclear renaissance is definitely on and in spades, and the long-term outlook couldn't be brighter. But having said that, I now see an outlier risk scenario for uranium miners in the short term that could lead to an outright washout. To be clear, this is not a prediction, nor is it my base case. I say again, this is an outlier tail risk, not a base case and not a prediction. But the short-term bearish setup that I see is real, and I think it's worth talking about. Start by asking yourself how it's even possible that the spot price of uranium was down considerably this week, despite the incredibly bullish news flow surrounding all things nuclear. The answer was given to us by Jeff Curry when, in his recent MacroVoices interview, Jeff reminded us that while the stock markets are forward-looking, commodity markets have to balance supply and demand in the here and now. The fact of the matter is that we have a conversion and enrichment bottleneck that will constrain the amount of U3O8 uranium that can be consumed. Now, to some extent, overfeeding in the enrichment process will overcome some of that bottleneck and will create a little bit more demand. But we still have a conversion bottleneck, and you can't enrich uranium until you convert it into gas first. So it's entirely plausible that the spot price of uranium could stay right where it is or even move lower for quite some time. The triple nuclear initiative and the nuclear renaissance are very real, but it will take years to build the new nuclear reactors that will create new demand for uranium and unbalance the spot market. Now, to some extent, the spot market was already unbalanced. Justin Hune's analysis over at uraniuminsider.com shows that. But in the here and now, right now, this month, The commodity market needs to balance current supply and demand. And with this constraint that we have on conversion and enrichment, I don't see any sane reason to expect immediate demand to increase markedly this week or this month. Now let's talk about what could crash the prices of uranium mining shares. Forget about fundamental analysis and technical analysis and all the rest. At the end of the day, all that really matters is who owns those shares and under what conditions they might start to panic sell them. In the case of uranium miners, there is famously very, very low institutional participation in those markets because until recently, ESG put all things nuclear off limits for most institutional investors. Next, with apologies, there's no nice way to say this, folks, but uranium miners are an area of investing that's dominated by retail investors who frankly have a bad habit of using margin to over-leverage themselves. And these are the same kind of investors who tend to panic sell bottoms rather than value buying them as they should. Now I want you to imagine that the dollar rally continues and that there's a significant downside risk event in the broader stock market as spot uranium sells off maybe another 10%. Now imagine the margin calls starting, with retail holders of the uranium miners now being forced to sell. Who are they going to sell to? That's the operative question to ask yourself. Who's going to step in to provide liquidity when margin calls start to become self-reinforcing and the inexperienced retail investors who overcommitted themselves to uranium miners that they bought on margin start to panic sell? Who is the buyer of last resort in that scenario? If you said could be nobody, well, then you understand why I see this as a very real risk scenario. Should smarter investors step in quickly based on expected future demand for uranium? Well, of course they should. The future demand is just out of sight. The bullish fundamentals couldn't possibly be stronger. But what if the people that would normally do the stepping in are also shrewd and experienced enough to see a retail margin call puke event coming? And what if the shrewdest among them were even to conspire to make it worse, to create an even better buying opportunity for themselves after first washing out the retail holders of uranium miners? Again, this is not my base case scenario, and I don't think it could happen without some kind of catalyst like a broad market risk event in order to bring it about. It's a tail risk that I don't think can happen without that broad market sell-off. But hey, wait a minute. Look at what we just saw the dollar index do. Look at what we just saw happen to the market on Wednesday. If that is presaging a bigger risk event still to come in the broader market, it could create a much, much bigger risk event in uranium mining shares. All the ingredients are in place for that to happen. If there's a misstep in the Trump 2.0 transition, or if for any other reason there's a broader market risk event that's considerably bigger than what we've seen so far. Bottom line, I still think the base case is exactly what Patrick has outlined in the past. We're in a basing formation on uranium miners that should set the stage for a move much, much higher on uranium and uranium miners in the new year. So I still think the base case is super bullish. But there's also this very real risk that a broad market risk event could be a catalyst that brings about an exaggerated downside event for uranium miners because too many weak hands are too leveraged and everyone is all in, thinking that the fundamentals are so strong that nothing can go wrong. They're actually right about how strong those fundamentals are, but there's always something that can go wrong. And I think that if you are a person who has leveraged yourself by using margin borrowing in order to buy more uranium mining shares than you can afford, now would be a really good time to rethink that strategy because you're going to want to be ready to ride out what could be a patch of stormy weather and not be forced to sell by margin calls, which is what I think could be coming for some retail holders of uranium miners if we get a broader market risk event.
Yeah, Eric, on page 7, I have that Sprott Physical Uranium Trust chart up. The spot prices of uranium continues to trade in this range. We have no activity yet. Obviously, there was some bullishness in a lot of the uranium equities that really hasn't shown on the spot prices of uranium yet. But at this point, I don't see anything active going on that spurs me to want to accumulate this as a new position. Finally, Eric, I wanted to just touch on that chart of the 10-year Treasury Yields on page 8. And what we had was a very distinct breakout in yields on this FOMC. We broke above that November high. And so now that March high around 466 and the September of last year high near 5% are the upside targets for some of these moves. These bonds really continue to, on the short-term, deteriorate. And with higher yields, this will continue to pressure almost all risk assets. So we have a very vulnerable period, and all of these charts continue to collaborate the fact that there's nothing safe at this moment. And a lot of people that have been very complacent may become uncomfortable, and that could spur some liquidity-driven selling.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.